For most people, the stock market feels like a foreign country, loud, unpredictable, and governed by rules no one ever fully explains. Prices move without warning. Headlines contradict each other. Experts disagree with confidence. And somewhere beneath the noise is a quiet anxiety, the fear that everyone else understands something you don't. The best books on the stock market were not written to eliminate uncertainty. They were written to teach you how to function intelligently within it. When beginners approach the stock market, they often ask the wrong question. They ask, which stock should I buy? The books that matter ask something else entirely. What is the stock market actually for? Until that question is answered, every tactic feels fragile. Books like The Intelligent Investor, A Random Walk Down Wall Street, and Common Stocks and Uncommon Profits all begin, implicitly or explicitly, by reframing the market not as a casino, but as a mechanism for allocating capital over time. This shift alone transforms confusion into context. At its core, the stock market is not about prices, it is about ownership. Every share represents a claim on a real business, with real employees, real customers, and real constraints. Books that endure insist on this perspective because it grounds decision-making. When you see stocks as pieces of businesses rather than symbols on a screen, volatility becomes less personal. Price movement becomes information, not judgment. This mental shift is the first step toward understanding. One of the most powerful lessons repeated across essential stock market books is the separation between market behavior and investor behavior. Markets move for countless reasons: economic data, emotion, speculation, fear, and sometimes pure randomness. Investors, however, are responsible for only one thing: how they respond. Books like The Psychology of Money make it clear that most losses are not caused by markets being cruel, but by people reacting poorly to normal market behavior. Understanding this distinction removes much of the mystery. The market is unpredictable. Your behavior doesn't have to be. Another foundational concept these books emphasize is time horizon. Beginners often approach the market with short-term expectations because short-term results are visible. But the stock market rewards patience disproportionately. Books consistently show that long-term investors benefit from compounding not because they are smarter, but because they give time permission to work. The market transfers wealth from the impatient to the patient, not through cleverness, but through endurance. This is not motivational, it is structural. Risk, too, is redefined by serious stock market literature. Popular culture frames risk as volatility, prices going up and down. But books aimed at understanding rather than speculation define risk as the probability of permanent loss. This distinction changes everything. Temporary declines become tolerable. Poor quality businesses become dangerous. Diversification stops feeling like dilution and starts feeling like protection. Understanding risk this way turns fear into analysis. Many essential books also dismantle the myth that the stock market is dominated by insiders with secret knowledge. While information asymmetry exists, the books emphasize that complexity does not equal advantage. In fact, complexity often harms individual investors by encouraging overconfidence and overtrading. Books like A Random Walk Down Wall Street argue that simplicity, broad diversification, low cost, and long-term discipline outperforms most active strategies over time. This idea is uncomfortable because it removes the fantasy of cleverness, but it replaces it with something more reliable: probability. As readers move deeper, they encounter another critical idea: the difference between speculation and investing. Speculation focuses on predicting price movement. Investing focuses on participating in value creation. Books do not condemn speculation, they clarify it. Problems arise when people speculate while believing they are investing. Understanding this distinction helps investors align expectations with behavior. If you are speculating, accept volatility and uncertainty. If you are investing, accept patience and boredom. Confusion between the two is one of the most common sources of frustration. Essential stock market books also teach readers how to think about valuation not as precision, but as range. Valuation is not about finding the exact worth of a company. It is about avoiding paying prices that require perfection. This is where concepts like margin of safety emerge. Books stress that humility matters more than accuracy. You don't need to know exactly what a business is worth to avoid obvious mistakes. You need only to recognize when expectations embedded in price are unreasonable. Another recurring lesson is that the stock market reflects human psychology more than economic theory. Fear and greed, optimism and despair, confidence and panic all leave fingerprints on price charts. Understanding this does not grant predictive power, but it grants emotional distance. When markets fall, books remind readers that pessimism always sounds intelligent in hindsight. When markets rise, optimism always feels justified. Recognizing these patterns helps investors resist being pulled into emotional extremes. As understanding grows, the stock market begins to feel less like a battlefield and more like a weather system. Storms come, calm returns, seasons repeat. The books that guide beginners effectively do not promise calm, they promise preparation. They teach readers to build portfolios that can endure volatility without demanding constant attention. They emphasize process over prediction, structure over reaction, long-term alignment over short-term noise. Perhaps the most reassuring message found across essential stock market books is that success does not require brilliance. It requires avoiding obvious errors consistently, chasing hype, overtrading, ignoring fees, concentrating risk unknowingly, reacting emotionally. The absence of these mistakes explains far more success than the presence of exceptional insight. This realization replaces intimidation with confidence. You don't need to outsmart the market. You need to cooperate with it. And as these lessons settle, a subtle shift occurs. The stock market stops feeling adversarial. It stops feeling like something happening to you. It becomes a tool, imperfect, volatile, but powerful for participating in economic growth over time. Understanding emerges not from mastering every detail, but from internalizing a few durable principles and applying them patiently. This is where true comprehension begins, not when confusion disappears, but when uncertainty becomes manageable. The books do not make the market predictable. They make you more predictable under pressure. And that predictability, calm, disciplined, and intentional, is what allows long-term investors to benefit from a system that appears chaotic on the surface, but rewards consistency beneath it. And it is at this point where the stock market transforms from mystery into framework that the deeper insights from these books begin to reveal themselves, guiding readers away from noise and toward clarity, away from reaction and toward structure, and toward a way of thinking that allows participation without panic, growth without obsession, and patience without doubt. And that transition continues forward, opening the door to the next layer of understanding, where knowledge becomes confidence and confidence becomes behavior, unfolding step by step like a map revealing itself only as you walk forward, not all at once, but precisely when you need it. And this is where understanding the stock market shifts from theory into behavior, from knowledge into calm execution. In the second half of this understanding, the books begin emphasizing something far more practical than charts or forecasts: structure. They show that the greatest danger in the stock market is not volatility, but improvisation. Investors who lack structure react to headlines, emotions, and short-term movements. Those who build structure, clear asset allocation, rules for buying and selling, predefined risk limits, remove decision-making from moments of stress. The market may remain unpredictable, but their responses do not. This is why essential books stress having a philosophy before having an opinion. Without a philosophy, every market movement feels personal. With one, fluctuations are simply data points. Investors who understand this stop asking what the market will do next and start asking whether their current allocation still matches their goals, time horizon, and tolerance for risk. This shift reduces anxiety dramatically because it replaces guessing with alignment. Another layer of understanding emerges around expectations. Many investors are disappointed not because markets fail, but because expectations were unrealistic. Books repeatedly clarify that average returns are not a flaw of the stock market, they are its promise. The market rewards participation, not brilliance. Once this is accepted, frustration fades. You stop demanding excitement from your portfolio and start demanding reliability. And reliability over decades is powerful. As readers mature, they also learn the discipline of inaction. This is one of the hardest lessons, and the books do not sugarcoat it. Most of the time, the correct response to market movement is no response at all. Not selling in panic, not buying out of excitement, not adjusting plans impulsively. Understanding the stock market eventually means understanding when to do nothing and trusting that doing nothing can be an intelligent act. Books also emphasize the importance of humility. Markets are larger than any individual. Certainty is dangerous. The most successful long-term investors assume they will be wrong sometimes and plan accordingly. They diversify, they avoid leverage they cannot survive. They accept that even good decisions can have bad outcomes in the short term. This humility does not weaken conviction, it strengthens resilience. Over time, understanding the stock market also reshapes identity. You stop seeing yourself as a trader trying to win and start seeing yourself as a participant in growth. You align with businesses, not bets. You respect cycles instead of fighting them. And slowly, almost unnoticed, your emotional relationship with money improves. The market no longer dominates your mood. It becomes a background force, sometimes noisy, sometimes calm, but rarely overwhelming. This is the quiet ending of the guide. Understanding the stock market does not mean mastering complexity. It means simplifying behavior. It means building a framework that allows you to participate without panic, grow without obsession, and stay invested long enough for time to do what it has always done best. The books do not promise certainty. They promise durability. If this reflection resonated with you, pause and ask yourself a simple question. Do your current actions reflect understanding or reaction? Share that insight. And if you want to continue exploring how books transform confusion into clarity and volatility into opportunity, stay connected. Subscribe, follow, and return. Because the stock market rewards not those who predict best, but those who behave best when it matters most.